I'm Greg Hunter. Welcome to USA Watchdog, a gentleman we haven't had on in a long time. He knows all about venture capital and also private equity. He knows all about technology. He was a big executive at Motorola, so he knows about technology. He knows about finance and the economy. I'm talking about Gordon T. Long. Gordon Long, thank you for joining us today on USAWatchdog.com.
Oh, it's my pleasure, Craig. I always enjoy our conversations.
I'm on your email string, and there's a lot, and I have to apologize. I haven't had you back on sooner, but because I've had an embarrassment of good bookings, of which you are one of them. But one of the things that came across my email string, and I read all the stuff I get from people, is your piece that titled "War on Cash."
Yes.
War on cash, and I've got to tell you just some of the highlights. It prevents negative interest rates. Of course, it can track everything that you do. It prevents bank runs. How do you take your cash out? And also, you cannot control the banks. Let's start with it prevents negative interest rates. Are we going to a cashless society where they can have negative interest rates?
They have to go to a cashless society to get to negative rates. Craig, we have had negative, real interest rates for quite some time. That's the whole premise of really paying down the government debt by effectively debasing it. But you run up against a wall, and we've ran up against that wall. Clearly, quantitative easing isn't working. And matter of fact, back in the late 1999, 2000, when we went into the dot-com bubble and we were looking for solutions, there was a number of papers that were out saying this is what we're going to have to do. 3 steps. One of them was quantitative easing. The second was the possibility of helicopter money drops, which we really haven't done, but is a possibility. And the third would be negative rates. Not negative real rates I just mentioned, but negative nominal rates. And by the way, we have $5 trillion trading this morning globally at negative nominal rates. Why would you buy a bond and pay the interest on the bond to hold it?
You're paying somebody to hold your money, to keep my money safe.
So why would you do it? The only time we ever see that is in the midst of a financial crisis. In 2008, if you recall, the short-term treasury bills went negative, and money markets was the issue. We didn't have it to this extent. So obviously there's people afraid of something and are willing to, it's the old Will Rogers from the Great Depression, it's not the return on money, it's the return of money. They want to feel that it's protected. And also, they're in the nature of currency wars, they can make more money on the currency on the bond than they can on the yield. So there's a lot of games going on.
So you're saying that the economy is so bad, it's so illiquid that they have to go to cashless, and so they can go to a negative interest rate. So we're not done with the basically distorting the system. They have to distort it even more by saying, okay, no more cash. Is that what you're saying?
Yes, I am. I'm saying we're still early in the second or third innings of what's to come, because we're trapped, Craig. We're trapped. And I wrote a paper on it called The Globalization Trap. And a simple way of thinking of this, with quantitative easing, what we're doing is we're bringing demand forward. Debt is nothing more than future demand brought in today's date. So we're really pushing at demand. But we can't bring any more forward. Matter of fact, real disposable income's falling. People really don't have the money to spend. Jobs aren't there, etc. But the issue, having said that, is not demand. Demand is growing moderately, I would argue maybe even shrinking, but the issue is oversupply. Because cheap money doesn't just allow you to buy something, it allows producers to produce. So the emerging markets, $9 trillion of carry trade has moved into emerging markets to produce, whether it's China with its factories, whether it's Indonesia in supply of raw materials. So we have so much overcapacity out there. And now all of a sudden the U.S. dollar is strengthening, which ties in. They're on the wrong side of the trade. They're getting squeezed. They have no pricing power. That's what happens. Remember your old supply and demand back in school? So they have no pricing power. So they've got to fight on price. And top line growth is not happening in the corporations. It's just not there.
Well, it is shrinking. We just had a surprise 7/10% in contraction in the first quarter. And you said back in 2014, when I first interviewed, you said, yeah, we're going to have trouble in 2015. That's when the trouble is going to start happening. And sure enough, you were right. We didn't have that much trouble in 2014. The oil patch fell out of bed late in the year and got surprised. Oil went from 100 to 40 or something. But what you're saying is that your prediction is coming true. Do we have a cashless society before it crashes? A lot of people think this fall is going to crash.
I've said that beginning in Q3, we're really out of runway. But never, Craig, never underestimate the ingenuity of a trapped politician and central bankers to come out with new policies and new ways to extend this. And we're going to see some pretty violent volatility and corrections. And it's my opinion, we're going to be in there guaranteeing collateral, because our issue is we have a shortage of high volume collateral out there that's underpinning all the market. When you take out debt, you only get it if you post some kind of collateral, right? They don't, whether it's your car, it's your house, or whatever. Well, what's happening is there's a shortage of collateral. One of the issues with this, Craig, is that the quantitative easing basically sucked all the bonds out of the market. They're all sitting over at the Fed. There's a shortage of them. So we have a major liquidity problem. Function of that, Basel III, what you've got to do with your capital requirements, Dodd-Frank in terms of prop desks, etc., all kind of good on the surface. But what they've done is they've stranglehold the banks who are no longer market makers. They're really working as agents. They find a buyer, they find a supplier. They're not taking any risk in the middle because they can't. So we don't have enough liquidity. That's the runway we're running out of, and flows are starting to slow dramatically. Now, that says it's getting unstable. That doesn't mean the world's coming to an end. But it does mean we're going to do something else, and one of these things is negative nominal rates, cashless society, and there's a reason why we have to have a cashless society. You're going to see this accelerate in the next 6 months.
Wow. So what about the Greek situation? I mean, when you're talking about running out of runway, I mean, the IMF last week gets up, walks out of a meeting. The Germans do not want to give any more money to the Greeks. Are they going to, and the idea that they're floating out here that, Greek can exit and they can default on this debt, no problem. I'm like, what? You can default? A little country like Greece has, 350 or $400 billion or dollars or euros, whatever you want to mark it in, debt? I mean, 350 billion euro in debt? And they can just say, poof, we're done. I mean, what happens with all the other countries that'll say, wow, I'm with Greece, I don't want to pay this back?
Exactly. This is a sign of complacency running amok. This is serious beyond. We're just sleepwalking into this thing. What frightens me the most, Craig, is we have a 555 trillion. Remember, our global economy is only 72 trillion in swaps. That's currency and interest rate swaps. That's money that has to be pledged on collateral. The underlying collateral of that is bonds. Okay? Now, a 1% change in interest rate on a 30-year note is a 20% change in the value downwards of the bond. Do you know what kind? You ever had a margin call, Craig?
No, but I know one thing, that we've been told debt is an asset, and it's not.
It's not.
In a rising interest rate environment, debt is never an asset, it's a liability. So we're going to find out that's a lie, right?
Precisely the point. And so you've got this swaps marketplace that's sitting on a hairy edge, and so any kind of default in Greece has profound implications, and you will have somebody equivalent to shouting fire in the theater and everybody looking for the exit. But this time, Craig, it's not going to be a matter of everybody jammed at the exit. The doors are going to be locked. The only way out is for you to exchange your seat with somebody who's outside the theater. And who's going to do that? So there's just not enough liquidity out there. And this is a kind of market, it's better to be 6 months early than 6 minutes late. And that's the kind of thing that's happening on this hairy edge. But it's about collateral. And we've pyramided this collateral with something called rehypothecation and collateral transformations, all this technical stuff the average person doesn't hear about, but it allows you just to keep pyramiding. And pyramids tend to break, right? And no, we're getting close, but we're not there yet.
So that's what this tells you. The Greek thing is a problem, and I know you write one of your publications is triggers. So the Greek thing is a trigger in your mind. I mean, this could be a huge trigger. You should be pulling both triggers in a double-barrel shotgun, could it not?
Yes, I believe that. I really do. But there's also a lot more going on. I mean, there's a lot of grandstanding, but we're out of time now with grandstanding. But I think that Putin is blowing in the Greek ear right now, and there's monies and other ways out, and they're putting a lot of pressure on Europe. That G7 used to be called G8, now the G7 meeting, really demonstrated that the sanctions on Russia are hurting Europe more than they're hurting Russia. And I didn't say they're not hurting Russia right now. So a problem with Greece is a massive problem. I'm still somewhat optimistic that there'll be some kind of buying a little bit more time. We will not resolve this. The best solution is actually Greece to exit, but we can't afford to debase these or devalue these bonds. It can't be done. So the answer may not be that the exit. The answer is going to be how the bonds are handled and how they're treated. That may take government guarantees that we've never seen before, IMF guarantees, etc.
But isn't the ball of junk so big? They're waiting for some fairy godmother type, exit to come down, some solution like, the country of Kazakhstan died and left you billions of dollars to pay your debt. I mean, there is either debt's paid off or it's defaulted on. And if governments have to back this debt and all the other sour debt, aren't governments going to go under? Is anybody going to trust the collateral, the paper, and then you have these banks leveraged up 50-1? You don't need a big move, to your point. I mean, aren't governments ultimately going to, aren't we getting a limit to government? Aren't they going to go under the next time?
Well, the next crisis is going to be the sovereign debt, and it's going to be in the bond market. I personally think it'll stem out of the insurance and pension problems where they can't fund, and credit is going to begin to collapse around muni bonds who are using money to pay pensions, etc. So, we're out of runway. And you look at it, we have north of $200 trillion now in debt structures out there, and even if it's only paying 4% on average. That historically, that's the duration. You got $8 trillion right there. Then you say, what's the global GDP? That the global GDP is $72 trillion, and you got expenses and everything else out of it. Where's the debt is now just literally consuming our seed corn. It's like in a farmer back your grandfather's day, where you had to put so much seed corn in the granary for next year's crop. Well, we're not only eating that seed corn, we're borrowing money. Well, at some point, somebody's not going to lend you the money, and somebody's going to have a bad crop somewhere, and that's kind of where we're at right now.
I mean, with Greece, Russia is not going to loan them money, give them money, and then Greece is going to turn around and pay off the IMF. They're not going to pay off the EU, the European Central Bank. They're going to say, great, we can pay our pensions and our workers and whatever, and we're defaulting on that stuff. I mean, that's how that's going to play out if that indeed happens, right? I mean,
yeah.
And if they do make a short-term deal, there's only 7 billion euros there left, which gets to this fall. I've had a lot of people say the perfect storm is going to hit this fall, that this fall is going to be the perfect storm of debt and disaster, and that we're not going to make it much past this fall. What say you?
Well, clearly there's many countries preparing for that. China, the BRIC countries, China, Russia, Brazil, South Africa, etc. A lot of the emerging markets, whether they're buying gold, whether they're trying to look at the creation of the Asian Industrial Infrastructure Bank to be able to fund $52 trillion in the Silk Road. They are looking and putting pressures on reformatting the IMF, which leads back to Greece here. So they see something coming that's very troubling to them. And right now, if China was to, for example, back its currency by gold, even in a small proportion, the currency cartel would implode. And by the way, when I say the currency cartel, we need to recognize that we have 95% of the global currencies basically trading on 4 currencies. The dollar, the euro, the pound, and the yen. And which four currencies are being debased the most with quantitative easing and printing?
Those four.
So if you're not in that cartel, what are you doing? You're getting inflation, you're getting hammered, you're getting forced into currency wars. So what do you start to do? You got to protect. It's not you want to be evil. You got to protect yourself. So they've got the gold. So if they were to say, and it comes up because IMF won't move to allow that. That's why the Asian Industrial Bank, the World Bank, isn't doing its job. The IMF is not doing its job, so it's created this. So if it says, look, I've got a problem, and it wants to start to back some of its currency with a little bit of gold, do you know how much of that 95% of the world's currency that feel they can't have no choice will trade and move across? If they do that, what will happen is we'll have excess dollars out there that aren't needed. And you're already seeing it with, we called it the petrodollar. Now we have the yuan dollar, or the yuan, the petro yuan, where they're trading between Russia and China now and using the yuan. That means less dollars. Less dollars means they got to come home because they're an IOU. That's what hyperinflation is about. That's what it begins. So
you talked about that in the last interview, but go ahead. I want you to talk about hyperinflation. Is that what's coming next for America?
Yes, it's coming, but not next. Because you have to remember that hyperinflation is a currency event. Hyperinflation is not about prices going up. It's about your currency going down, which means things are more expensive to you. And when hyperinflation happens, I've studied 52 different events. It's very quick and very short. It can be only a matter of a few weeks or 6 months, and the currency implodes. But what happens is it's a lack of confidence. What triggers a lack of confidence? In this case I just spelled out, all of a sudden you have an alternative to the debasement in these developed countries that are using financial repression really to get out of debt they can't get out of any other way. But because you have no choice. But if somebody else gives you a choice of currency, the money will flow, and then you have a currency crisis. I believe, for what it's worth, that we're going to have more deflation. We're going to have both deflation and inflation, but we're going to have more deflation because of this oversupply I talked about, the excess supply, not about demand, which is going to start to collapse collateral values, which are going to hurt assets. I believe very quickly governments will move to guaranteeing collateral, etc. When that happens, then we get into the hyperinflation. So there's a down, panic, then we go up. And I actually think, especially with the governments buying the amount of equities they're now buying through pensions, through sovereign wealth funds, we could have a Minsky melt-up, but not yet.
So you're saying if we do get the meltdown this fall, they are going to pull the fire trucks out, they're going to pull the liquidity hoses out, and they're going to spray that meltdown with liquidity, and they're going to back everything in the world. If we do get a meltdown this fall, the result, the reaction is going to be pour liquidity in, guarantee everything. It'll be 2008 on steroids.
You got it. And I suspect we'll be guaranteeing things we never thought we'd guarantee. I think there'll be issues in the ETF market, international ETFs. There'll be mutual funds. There's going to be all sorts of things we've never guaranteed before that they will be forced into doing to keeping the system liquid. It's just not a matter of cheap money anymore. That runway is over. It's a matter of guaranteeing the flows, which is collateral.
The bonds.
The bonds. That's the trigger point. And so once you start to understand that, then there's all sorts of scenarios you start to look at. That's why this gig will go on for a while, but I didn't say it's going to be an easy one. And the problem, too, is that the system is so intertwined and so fragile. Something can break, and it's not like when 2008 where the Fed could take control, if you would, make decisions. When it's global, you get arguments, you get difference of opinions, and the thing, meanwhile, is imploding in real time. Can they react fast enough? Do they understand the problem? That's the scary part, which could impact supply.
Then you got the Federal Reserve saying, oh, well, we're going to come in, but we're only going to protect our banks. And the Chinese central bank says, whoa, 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 no, you're not. No. That's against our best interest. That's when you get the fighting, what you're talking about. So the Fed comes in, they basically protected their buddies the last time. They didn't protect China. They didn't protect Russia. They certainly didn't do that. And they're going to have a say this next time with the BRICS and the AAIB and all that. That's what you're saying. The next time, we're going to be a big food fight over who gets bailed out and how it works out, correct?
Yes, and that's the wild card in here. Don't for a minute think that they're not already working and looking at alternative strategies and things that can be done. They know what's ahead here. So, how it unfolds, they don't know, and how other parties will react, and as you say correctly, how China will react. The big wild card is in IMF and the World Bank, what the United States and the European is willing to surrender in regards to control of these agencies, because that's part of the war that's going on right now.
Could we get a real war?
No. But could
we get a shooting war with all this coming down? So they'll just start shooting and turn the table over.
You never know, do you? But I do believe we're going to see a form of cyber war that will disrupt supply, disrupt financial markets, that will create the false flag, if you would, for kinds of policy implementation. We will never accept it unless our stores weren't working or our ATMs weren't working. Things like that.
You mean like the cyber attack that happened last week where all government employees' data was stolen, hacked by somebody? The U.S. government is saying China says no. But you're talking about a hack like that where all the data at the IRS is stolen? You mean a hack like that just happened?
Similar to those sort of things. It could be in the SWIFT program of international transactions. It could be in currency. It could be in some of the trading mechanisms. You don't know where it's going to come out, but I do know this, that every major country in the world has now got cyber command centers of highly large staffs looking at both defensive and offensive. So the chances are pretty good that it'll come out of there, and it'll probably just somebody will have done something, and it triggers one. It goes back and forth, and we're attacking before we really know we're, quote, in a war. But I think cooler heads would prevail. The issue is the instability it creates, and who's got the smarts to know how to solve it in real time.
We're at least going to get inflation, and that means if you're talking about hyperinflation, you must be liking gold. The Chinese are liking gold.
Yeah,
the Russians are liking gold. The Brazilians are liking gold. The Indians from India are liking gold. I also heard from one of my sources that you can't even find gold coins in Europe anymore. I mean, nobody's selling them, and people would like to buy them, but nobody's selling them. There's no supply of gold coins. So we're seeing that even at a low price, the supply. What's your outlook on gold and silver?
I'm very bullish, but not quite yet. But the issue with the precious metals.
Oh, wait. What do you mean by that? I'm very bullish, but not quite yet. What does that mean?
Well, a little bit more time, because right now the paper market in gold is clearly being I'll use the word manipulated for lack of better words. In actual the physical, it is very, very hard to get it. The key here is going to be where it's stored, who holds it. From a geographical standpoint, and under which country do you have it? Because my opinion is it's going to be taxed, and taxed at a very, very substantial rate in a lot of countries who are in financial troubles. They won't confiscate it like we did in the 30s, but my opinion. But the taxation that'll go with it, because you'll be a financial terrorist in many ways if you're not supporting the currency of the country. I may be exaggerating a little bit there, but I'm very, very bullish on it. But it's very much where you hold it. It's nothing more than an insurance policy. I have insurance on my house, but I don't want my house to burn down too, right?
Right.
But I know right now I got people running around here with fires, torches in their hands, so I'm getting nervous.
And is it a dollar price relative to gold? Is that even relative? I mean, is the dollar going to disappear, or will the dollar price of gold go away? The dollar will go way down, and gold will go way up. And we're talking about in the thousands of dollars per ounce. What are you talking about?
Everybody keeps talking about gold not going anywhere. It's because everybody's denominating in U.S. dollars. I mean, there's many places gold has been great this year. If you were in gold and bought it in yen and had a short, and our ETFs that have it short on the yen, you've done really, really well. Gold has been a good move. In many cases, gold has been a good move, but not in U.S. dollars in the short term. So again, when I say hold it, it's not just physically, but how you have it denominated and how you have it hedged. But if you're just looking at it in U.S. dollars, I see days coming where you will have $100 ounce days in gold.
Goes up $100 an ounce in a single day.
Yes, but you won't even be able to get it. But,
so in other words, the price will be in the thousands, not in the 1,200, 1,100 type range. You're talking about gold. Where do you think it will end up going to?
I could give you numbers, and they are up in that level, but that's not going to be your issue. Your issue then is going to be something far more serious.
Which is?
Than what your value of your gold. Well, it's going to be just the basic needs of what you're going to buy with it, because gold is nothing more or anything like that than a store of value. And what wealth is having something that will get you something you want. But if you have all the gold and it still isn't going to buy you what you want because there's a shortage of supply, it's not really that valuable anymore to you. So my bigger issue is if we disrupt the system, we disrupt the supply within the system. Food, energy, power, etc. So cyber attacks can disrupt power. What good is your gold then, right? Except in other ways. So it's going to happen. I believe you'll see it at that level, but it'll be what does the government and powers to be do before it happens, when it's happening, and as it's happening. And it reminds me of when Apollo 13 went around the moon. You remember? I don't know if you were.
Oh yeah.
When they came out, and we didn't know whether they were alive, and the world spent about a day holding its breath. It was something I'd only seen after Kennedy's assassination. It was incredible how the world just froze. I think what we're going to see later, maybe 215, 216, is the world is going to freeze in a similar manner for maybe 2 weeks. And it's going to be, as all these things I'm talking about happen, and the world leaders feverishly figure out what to do, but at that point, we can't move our money in the ATMs. Gold may be going through the roof, but we couldn't sell it, use it anyway. And when they come out with the answers, they may involve a devaluation of the American dollar by 80% or 90%. Or that level of, because it's going to take that kind of massive rebalancing, because the fundamental issue we have right now is we consume vastly more than we produce as countries, and you can't keep sustaining that. So we need an adjustment. And what we have is change trying to happen right now on a global basis. We've had major shifts, and that rebalancing needs to happen. That's why I mentioned the IMF, World Bank, AIB.
Christine Lagarde has talked about that. She's talking about that. That's what you're talking about. Now you're spelling out what she's really saying to rebalance. We need to, the U.S. needs to take steps. You're talking about a rebalance and take the dollar down 80%. Whew, boy, the inflation wouldn't be hyperinflation, but it'd be a huge inflation.
But you may decide that's a better solution than what you're seeing. You may say, we've got to live with this. So it often takes a crisis for the change. But we have change trying to happen with globalization, monumental, and it's overdue. We needed to have had a Bretton Woods 3 10 years ago or 12 years ago. So it's going to fracture. And Christine Lagarde understands this more than anybody, because remember her background. Before she went in there, she managed the largest law firm in the world, 2,700 lawyers. What did they do? They wrote swaps contracts. That's what they did. They wrote international financial agreements in the shadow banking system. She knows in spades how this world is working. That's why That's why she got the appointment that she did.
We're going to have a big.
Opinion.
I'm sorry. Go ahead.
I just said my opinion.
Oh, well, your opinion is a good opinion. That's why I have you on. So you're saying that without question, the dollar at some point is going to be dramatically revalued. Has to be.
Absolutely. But it will be the last currency to fall. Even though it's the biggest problem, it will be the last to fail. And that's why right now I believe gold or U.S. dollar will have some short-term consolidation work, but I think we have higher highs in the U.S. dollar for all the wrong reasons. We have $9 trillion that's been taken out of America in terms of loans in a carry trade that's fundamentally arrived around the world in these emerging markets that created that supply glut that I've talked about. Now that the money they borrowed in U.S. dollars is going up and their business is falling off, that's called a difficult thing to pay back in the larger dollar. So they're scrambling. That's almost a short squeeze. And it's only going to get worse unless demand picks up, and demand can't pick up. So I think it'll push the U.S. dollar higher, which hurts earnings, it hurts a lot of different things. That's part of the problem. They've got to get the dollar down.
Very interesting, Gordon T. Long. Gordon T. Long, thank you for joining us today. Your website, GordonTLong.com. Gordon Long, thank you for joining us today on USAWatchdog.com.
Always enjoy it. Thank you very much.